All right, welcome back to the channel. So today we're going to be revisiting Crocs. They released Q2 earnings today and they got absolutely destroyed, down about 14.22% on the day. This is one that I made a video on about a year ago, probably when it was in the 70s, 50s or so, and it's had a nice run up and now it's starting to pull back. So I thought we would revisit it and see what we get out of the updated valuation. This is just going to be a really brief video, hopefully. I'm not going to go too in depth since I have another video on it. But let's go on over to the latest press release for their Q2 earnings. All right, so the breakdown on their earnings, second quarter operating margins 30%. They raised full year outlook for revenues, operating margins, and earnings per share. They beat on their top line, they beat on their bottom line. And the stock is down 15%. They basically revised down their Hey Dude brand top line growth from mid-20s to mid-teens. And I think that's mostly what the market is freaking out about. So their prior guidance on total revenue growth was around 11 to 14. They revised that to 12.5 to 14.5. Crocs revenue growth was from 7 to 9 to 12 to 13. So seeing a lot better revenue growth on the Crocs brand than they expected. Hey Dude, their prior guidance was mid-20s, and now they're saying 14 to 18, which is still pretty good growth, right? Pro forma mid-teens, 3.5 to 7.5. Adjusted operating margins, they're expecting higher operating margins, which is great. Adjusted one-time costs 30 to 35, so a little bit higher costs. Tax rate 20-25. So adjusted diluted EPS went from their prior guidance of 11.17 to 11.73 to the 11.83 to 12.22 mark. So yeah, pretty interesting that they released a fairly good quarter. I would say fairly good quarter, and it went down 15% on the day. I gotta love the market, man. It's crazy. But I listened to their earnings calls earlier, and most of the questions and it looks like most of the concerns were really around the Hey Dude brand and the pullback in demand on Hey Dude. I think the market's really not liking that. At least analysts were really harping on that. So I don't know. Take with that what you will. I was mostly concerned about, with the Hey Dude acquisition, the recovery in operating margins. And they've made those efficiencies and they've started to get better operating margins on the brand. And we can see that their operating margins have expanded pretty nicely since the acquisition. Operating margins right here were about 17%, went up to 26, 23, 27. Now they're sitting around 30. And I don't know if those are the adjusted or not. We'll have to wait probably a week or so for this data get updated, but they have seen some nice margin expansion off of their operating profit margin now that they're kind of incorporating the brand into the basically the playbook that they've used for Crocs. Seems like they are starting to gain some of those efficiencies. When we look at the evaluation, it's been just kind of steady. They've done pretty good as far as they saw the huge COVID boom. And I know I mentioned that in the last video. It's going to be very interesting to see if they could keep it up. And they have kept it up, surprisingly. We've continued to see decent bottom line and top line growth. And their brand seems to be holding up pretty well. So they have been buying back shares over the last decade or so. And another thing to note, they did recently just this quarter, they said they got their leverage ratios under 2x, so they have started buying back shares again. Currently, they're sitting at a PE of about 10, something like that. Yeah, it's pretty crazy. Their net yield is about 10.47 right now. EBIT yield 13.68. So actually, those are probably off from this quarter, but still, they're yielding a decent amount to the bottom line, so buybacks I am totally fine with in this case. And they are going to continue to try to get that debt under control. I think they are at about, they paid back another like 240 million or something like that. So they're slowly just chipping away at that debt, and this looks like it might have the updated numbers. Yeah, so from 2460 to 2211, so 200 and some million in debt payoff. So their leverage ratios are getting a lot better. And speaking of leverage ratios, let's just for kicks, let's go over here to the REIT metrics, operating cash flow, total debt. So you can kind of see how much they levered up on that Hey Dude acquisition. They took on a lot of debt, obviously, compared to the operating cash flow previously. And yeah, so that's been probably a little bit concerning. Let's see, that's through 2022 though. We should have monthly ratios on that actually. I'll have to put that together. So anyway, we can see the massive increase in debt, but it is coming down as they delever. This is at 2594, and now it's probably around, why did we just say 21 or 22? Free cash flow going over there, we can see that the operating cash flow has continued to increase nicely. Looks like this second quarter hasn't updated as far as operating cash flow. Sometimes it takes financial modeling prep a couple days or weeks, or not weeks, but week to get all of the new data. So got to work with what I got for now. If we go over to the valuation, let's see. So I kind of penciled this out again, going off of kind of my previous estimates as well, targeting a 15% CAGR with a 5% margin of safety. And we see, let's see, under the, we're going to do net income only, and then under the very bearish scenario, or very bullish scenario, or not very bullish scenario, sorry, gets us to about 1.1 billion in year 4, and that was pretty much equal to my year 5 scenario on my previous valuation. So really nothing has really changed as far as the I don't know, the valuation previously. I'm kind of going off the same metrics. The one thing I will say is that I'm not accounting for as much as a drawdown, and I probably could. Maybe I will. So the spread, I think I could make it a lot wider. Previously I wasn't, but we could do very bearish of like 4.9% growth to the very bullish of 15.6% growth. Base case is about 8.83, but I don't know, like I'm gaining more confidence in their ability to actually have sustainable net income growth over time and have more brand power. I feel like they're proving themselves over and over again. I know this reaction of the market is really, I think, questioning that brand power and questioning if the growth is going to continue for just top line sales and demand for the brand, specifically Hey Dude, but I think also Crocs. But I don't know, like I'm leaning personally towards I don't know, accepting that they're probably going to maintain this brand power going forward, and they'll probably have less of a severe downside risk. But you never know with these things. Like fashion trends can change so quickly. You just don't know if it does flip, it could get so nasty, it could get really bad. But so let's do a 20% scenario spread, and we'll say 6.43 to 15.69. On the dilution, I'm actually going to start looking at buybacks. So buybacks in the very bullish case of 2%, very bearish case of 3.52%, and I'm actually increasing the buybacks in the worst scenarios because their yields would be so much better. So it'd actually give them more buying power. And in this case, we can kind of see that on the base scenario, we'd be projecting about just under $1 billion in net income after 4 years, and just over 1.07 billion in net income after 5 years. We look at the yield multiples that they've had, that the market has given them, and it's kind of been all over the place. And I don't know, it's almost like the market hasn't officially kind of priced them in at a steady multiple, because it just doubts the sustainability and the durability of their cash flow, which kind of goes back to, I don't think the market is like really, I don't know, I think they're assuming that their cash flows and the durability of those cash flows are very low, and that fashion trends could change and Crocs could just go away. If it doesn't, and they keep up, having enough net income to where they're like a 10% yield of their bottom line, it gives them so much power to buy back shares and return capital to shareholder like that, or to pay off debt. So, and they'll probably do a mix of both. So under this situation, we got a base CAGR of a target rate of 15% with a 5% margin of safety. So total target is 20%. We can see that the very bearish buy price is about 67. The bearish is 80. The base case is 95. The bullish is 118. The very bullish is 149. 5-year targets at the end of the 5-year period. The yield multiple in the very bearish would be about 9.88. The bearish would be 8.82. Base case 7.88. 705 in the bullish and 6.3 in the very bullish. And we can see that I'm basically saying like it's gonna moderate somewhere around here. It's basically kind of at the upper end of where the net yield has kind of settled into. So I'm being a little conservative, between 6 to 10 or so. I feel pretty good with that. We can see the 5-year targets at the end of the 5-year period in these theoretical scenarios. The 5-year target for the bearish scenario would be 176. For the bearish scenario, it would be 208. The base case would be 250, the bullish would be 308, and the very bullish would be 389. So yeah, this is interesting. And it could get to the point where, if they have a lot of firepower, they could potentially buy back a lot more shares in this, but I think they're going to really balance getting their leverage under control. And it's also interesting to know that, where is it at here? Yeah, so here we have the enterprise value versus market cap, and enterprise value, you can actually see they are basically at all-time highs, or they were at all-time highs. Once this updates, they won't be. I think their current enterprise value is going to be somewhere around, let's see, EV template. Current enterprise value is looking like it's at 8.7, so it's definitely not at all-time highs now, but they recently were kind of at all-time highs from the enterprise value. So this is an interesting one. It'll be interesting to see how it plays out. I think the market's reaction today really just is an indication of the doubt that Crocs is going to be able to maintain this, brand recognition and brand growth. If they are able to do that, not even improve it, but if they're just able to maintain, it could be pretty good going forward. But if they lose that brand recognition and they lose some of that, the durability of their cash flows, the ability to, have those really good operating margins and get a good gross margin on their product because their brand is strong. If they lose that brand strength, it could get fun. It could get fun quick. So anyways, hope you guys have had a great day, and yeah, we'll talk to you later. As always, this is not financial advice. This is just my musings and looking over another company. So do your own research, your own valuation, everything, and do not, buy or sell or do anything based off of a guy, on YouTube ever. Please don't do it.